nested expanding triangle, 5-minute expanding triangle top, nested within a 60-minute expanding triangle, but 9-bar bull microchannel. I'm not willing to sell below 11. For the bulls, it's an inside bar, so it's a high 1, similar to 9, but it's also a bear bar like 9, so it's not a very high probability buy setup. It's always in long. Odds favor higher, but will it go higher enough to justify buying up here? I'm not going to. I'll let it go. Why are we going up? Because everybody wants to buy a pullback. And if everybody wants to buy a pullback, a lot of traders will buy at the market small, just in case we do not get a pullback and just keep going up. They want to make sure that they make some profit. And right now we still have a lot of traders doing that. We have enough traders doing it for the market to stay in the bull microchannel. Can you start to sell with limit orders? Well, how profitable has that been today? Traders who sold above 5 were able to make a point. Traders who sold above 9 have not been able to make a point. If you're selling the 9 high, that's to fall 5 ticks for you to make 4 ticks, 1 point, and it only fell 4 ticks. So even though it's not strongly bullish, at least not yet, the bears are not making money, and that's always dangerous if you're thinking about shorting. It's better only to short after you see bears make some money. If the bears cannot make money even with limit orders, I talked about this on Friday, right? If the bears cannot make money even with limit orders, it usually means the market has to go higher to find sellers. So if you look at a chart and you say, yeah, it doesn't look all that bullish, but you look at it and say, well, wait a minute, the bears are not making any money. That usually means the market has to go higher to find sellers. It may not go a lot higher, but it has to go at least a little higher. This is bar 12, and right now the hour is closing on the high, good for the bulls. Instead of reversing down from an expanding triangle, the bulls are trying to get a bull breakout. Whenever you have a relatively big bull bar, 60-minute chart, closing on or near its high, the market usually wants to go above the high of that bar to see what's there, where bulls buy. And this hour is closing near the high, and therefore will probably go above the high of this hour, which is bar 12. Sometimes it'll only go a tick or two above, so you always have to be careful. If you buy on the stop 1 tick above the high of the first hour, very often it'll just go 1 or 2 ticks above and then reverse. To protect yourself from some crazy big loss, you can always get out a point below a bull bar, bar 12, a tick below a bear bar, bar 11. Okay, so that's the end of the first hour, and we just went above the high of the first hour. The bulls are hoping 12 is a breakout, and that it will lead to a measured move up. It probably will not, but that's what the bulls are hoping. Gets us up there. It's still a long way from the 4404 measured move target on the daily chart. A lot of overlap, a lot of prominent tails. So despite the bull microchannel, there's something wrong with the bull trend. The bulls are hoping 12 is breaking out. It's closing above something, closing above 11, and they're hoping it leads to a measured move up. The bears are hoping 12 is a bull trap, that the breakout will fail, and that we will reverse down on 13. But even if we do reverse down on 13, because of the 11-bar bull microchannel, there'll be a shortage of traders willing to sell below 13. You can call it a parabolic wedge, 2, 8, but the 11 bar bull microchannel, I think will make a lot of bears wait for a second sell signal and not sell below 13. Bulls, I would get out a point below a bull bar, and if 13 is a bear bar closing near its low, I definitely would get out. Parabolic wedge, possible expanding triangle. Good enough to get out, but not good enough to get into a short. Bulls trying to get consecutive bull bars closing near their highs and with good sized bodies. They're trying to get a bull breakout above a bull channel. That would increase the chances that we're going to go higher. We're in a bull channel and then consecutive bull bars closing on their highs. So a breakout above the bull channel. That's what the bulls are hoping that we get, that the character of the day is becoming much more strongly bullish. A bull channel, a pair of bull bars. The bears tried to reverse and we went sideways for a lot of hours, but that breakout changed the character of the market. So instead of a possible top, the top failed and we got trend resumption up. A weak bull trend and then a breakout and a follow-through bar, and we got higher prices. A bull channel and then a breakout and follow-through. Breakout, follow-through, we got at least a small second leg up. Now, what happens if we have a fairly conspicuous tail, 13? That will reduce the number of bulls buying the close of 13. I don't think this is going to be a measuring gap, although it might. But right now, look where we are. We had that collection of big bars on the open, and then a breakout 6. Even though 7 pulled back below the breakout, we're pretty much at a measured move, but nothing to sell. The tail will reduce the number of bulls buying the close, but it's still good for the bulls. It's a surprise. You look at it and you say, oh, 12, 13, that's different from what we've had, and therefore it's a surprise. How many bars can we have in the micro channel? Well, right now we've had 12. Although that's a lot, we could have a lot more. $25 bars without a pullback. Every low at or above the low of the prior bar. So a 25 bar bull micro channel. 17 bar bull micro channel. 17 bar bull micro channel. 14 bar bull micro channel. 14 bar bull micro channel, reversal for 3 bars, and then resumption of the bull trend. Now, what about what I said on the open, that we had a 75% chance of a couple hours of sideways to down trading starting by the end of the second hour? That's still true. Can you sell? Failed breakout, top of a tight bull channel, parabolic wedge? Nope. Wait to see bears make money, at least with limit orders. This is still by the market. Can you put a stop below 12 instead of a point or two below 14? If it reverses, it's going to go below 12. So I would rather use a tighter stop. Remember what I said on the open. If you have a reversal and a bull trend, one of the first targets is the bottom of the most recent Y climax, the most recent breakout. And that right now is the 12 low. Why the tail 13 and the doji inside bar 14? Traders tend to think in terms of 1 point, 2 points, 4 points, 5 points, 10 points, 20 points. a bull who bought above 3, if he's trying to make 10 points is 40 ticks, it has to go up 42 ticks. And the high of 13 is, I think, 43 ticks above 3. So that tells you some of the bulls who bought above 3 are taking partial profits here at 10 points. High 144. Chances are we'll get at least a small second leg up. That tail on the top of 13, I think it's important. When you get those breakouts above a channel, you really want the breakout bars both to close on or near their highs. That increases the probability that will go higher. Pair of bull bars closing near their highs. Reverse tested near the bi-climax low, but minor reversal. So if we reverse, it's probably only going to be minor. A tail and sideways. Well, this was the most interesting bull breakout of a bull channel in my trading career. I started trading right before the crash in '87, and we were in a bull channel and then broke out above the top of the bull channel, and we've been in a huge bull trend ever since. Most of the time, if it breaks above the top of a bull channel, it's going to reverse 75% of the time. 25% of the time, it'll be the start of a new bull trend. And the most dramatic example of this is right here. That breakout in 1995 was the most dramatic breakout, I think, in the past probably 40 years, 50 years. High 1, bull bar, should get at least a small second leg up. And for the bears, it's now a 13-bar bull microchannel, probably buyers not too far below 15. So I'm not willing to sell. And for the bulls, they can get out a point or two below bull bar. They can get out a point below bar 12. But if we pull back, if we reverse, I think it's going to be a minor reversal. Minor reversal means sideways for a few bars, sideways to down. Here we had 2 to 3 little legs down, but more sideways than down. Here, reversed down for about an hour, resumed up. 17-bar bull microchannel, unlikely to become a bear trend without first entering a trading range. The bears tried to get an endless pullback and then a bear trend, but bulls bought it. Sold off for 3 bars, 2 bear bars, yet minor reversal. So if we do reverse 15, it probably will be minor, even if it lasts 5 or 10 bars. Hesitation, tail 13, 14, 15, but minor reversal. So I would not short at the market. I would not short the 14 high. I would not short below 15. I would not short below 16. But bulls, realistically, it's probably only a minor reversal. It could last 5 or 10 bars. It could stay long. My general rule is to get out a point or so below a bull bar or a tick below a bear bar, closing below its midpoint, and then wait for the next buy signal. 13-bar bull microchannel, probably bulls will buy the 15 low. This is why in situations like this, I tend to use the early exit, the tighter stop. Can this be the high of the day? Parabolic wedge, 2 and 8. It could be, but I still think there'll be buyers not too far below. And I think we'll probably have to go sideways for a number of bars before we can go down, if we go down. Remember, I said 75% chance we'll go sideways to down for at least a couple hours, starting before the end of the second hour. So it might be starting here, don't know. Now, what do the bears need to short? I think more than what we have. The parabolic wedge is not good enough. We've got 4 bull bars and a 13-bar bull microchannel. So even though it's a good bear surprise bar, it's probably not going to be the start of a sharp reversal down. It's the end of a bull trend, but it could be the start of a trading range, and I think that's more likely. What do I need to see to short? What happens if we get a pair of big bear bars, 16, 17, a surprisingly big pair of bear bars? That would increase the chances that we'll get at least a small second leg down. Okay, 16 is closing near its low. It's enough of a bear surprise so that we'll probably get at least a small second leg sideways to down, but we're still always in long. Bulls buying the market, trying to prevent the market from going below a bear bar, 16. But as I said, I would get out of longs a point below a bull bar, 15. You could get out a tick below a bear bar, 16. And as for shorting, 15, a 13-bar bull microchannel, probably this is not going to go down very far. There should be buyers at the 15 low. Microchannel, you'll have bulls with limit orders at the low of the prior bar, and they buy the 15 low. They buy more, 1 point lower, 2 points lower, 3 points lower, confident that it's going to go above that 15 low. And they probably have about a 75% chance of being right. So limit order bulls buy here. Swing bulls, reasonable to get out of longs here. And for the bears, I think it's still too early to short. The character of the market changed with that bar, a bear surprise bar. So it's like this. Here, it led to a couple hours of sideways trading. I don't know what it will do here, but it definitely changes the character of the market. Here, sideways to down. This is a bull microchannel and a bear surprise bar. We got a second leg down here, a third leg here. It's more sideways than down. Bear surprise bar here, a couple legs down. Bear surprise. Here, a deeper pullback, but it's still only led to a trading range, not a bear trend. And that's what's likely now. That's what I mean by minor reversal. Bear surprise. So minor reversal means not a reversal, not a trend reversal into a bear trend. Limit order bulls bought the 15 low, right? They knew they had a very high probability of making money by the 15 low, by more 1 point lower. It has to get above that 15 low. They buy the 15 low, they place orders to buy 1 point lower, 2 points lower, 3 points lower, and it has to get 1 tick back above that 15 low. That allows them to get out break even on their first buy at the 15 low, and then with a profit on whatever lower buys they took. Here, they would only be able to, they could have scaled in twice here. We went down 9 ticks. 9 ticks is also important for the bears because some bears sold below 15. I would not. Hoping for a couple points, it has to fall 10 ticks for them to make 8 ticks, 2 points. So you have a lot of bears with limit orders to buy 2 points below 15 or 10. The limit order is 9 ticks below for them to make 8 ticks. And the bulls are scaling in 8 ticks below. So you have a lot of buy limit orders, 1 point, 2 points below 15. 5 ticks, 6 ticks, 8 ticks, 9 ticks, 10 ticks. High one, but a bear surprise bar. So that will reduce the number of bulls willing to take the buy. And for the bears, they know it's probably only a minor reversal, but it's a good enough bear surprise bar so that we'll probably get a second leg down. Sometimes it'll go up to a new high and then you get the second leg down. But chances are the character of the market has changed from strongly bullish or reasonably strongly bullish into less bullish or into a trading range. Above the 15 low, some bull scalpers can exit. Stop order bulls might buy, use a wide stop, scale in. Wide stop, bear surprise 16, might get a second or third leg sideways to down. So if you're buying 17, it's better to use a wider stop, maybe below 12. Why are we hesitating here? Well, you get some bears starting to sell with limit orders, expecting a second leg sideways to down. And after a bear surprise, you'll have some bulls not wanting to buy a high 1, instead preferring to buy a high 2 or wedge bull flag. You can see the limit order traders' character of the market is changing from less bullish to a little bit more neutral. Because of the bear surprise bar 16, fewer bulls were willing to buy above 17 because they thought we're probably going to get a second or third leg down. So why not wait for the second leg down and then look to buy? And 19 qualifies. It's the minimum expectation. Now, if you're a bear and you made a mistake and sold the 16 close, and then you see 17, what are you thinking? You're thinking, oh, that's bad. All right, so some of the bears who sold the 16 close, hoping for a parabolic wedge top and the start of a bear trend, will buy back their shorts around their entry price, around the 16 close. So you have bears buying there. It's a lower high 18, but 2 bull bars. So you have bulls buying below 18. So both bulls and bears buying as it goes down, and probably both bulls and bears selling as it goes up. If you're a bull and you did not get out, then you see then you see the big bear bar 16, you're thinking, okay, it's probably less bullish. Okay, so if you bought the 14 close, 15 close, you're thinking, maybe I'll place a limit order to get out around break even. And you can see 18 went up to that 15 close and turned down. So part of that is the bulls who bought the 14 high, the 14 close, the 15 close, trying to get out around break even. Had I done that, a lot of times after a bear surprise, instead of me placing a limit order to get out break even, I'm willing to take a 2-tick loss or a 1-tick loss. So I'll put my limit order a tick or two below. Let's say I bought the close of 15. I might place a limit order to get out a tick or two below 15, below the close of 15. So that's how you get micro double tops and bear trends from micro double tops. Bulls trying to get out break even. If they bought at the first high and then they see a bear surprise, they try to get out break even, and you get a second reversal down. This is probably a minor reversal sideways. I think nothing to sell yet. High 2, but a bear bar. So that will reduce the number of bulls buying above 19. There might be some limit order bears selling above 19, above 15, betting that if we go up, we're probably not going to go much higher up, and that we're transitioning into a trading range. And there will also be bulls buying below 16 and around the moving average, betting that whatever reversal we get will be minor and lead to a trading range. So we might be converting from a moderate bull trend into a trading range. High 2, but a bear bar. So might be more sellers than buyers, 19 high. because it's a tight trading range, we're starting to get bears willing to sell, especially after bear bar 16 and now another bear bar 19. Bulls still willing to buy, confident that even if we go sideways for an hour, sideways to down, it's still probably only a minor reversal and not the start of a bear trend. Triangle in a bull trend. You can say, well, it's breakout mode. It is, but it's more likely after just 5 or 10 bars, it's more likely that the bull trend will resume than it is that we'll get a reversal. However, when you have a triangle late in a bull trend, it usually ends up as the final bull flag. So that means even though we might get a new high of the day, we're probably not going to go a lot higher. Also remember that 75% chance we're going to enter a trading range by the end of the second hour. So if we do go up for a few bars, maybe into around 8:30 or so, and reverse down, we can end up in a tight trading range around the apex of the triangle. So yeah, I think we're going higher, but I think that we're not going a lot higher because 75% chance we're going to have at least a couple hours of sideways to down trading starting by around the end of the second hour. Triangle, we have 3 lows and we have a lower high. Bear bar 21 lowers the probability for the bulls, but odds are we're going to go higher, but probably not a lot higher. And remember I said that 75% chance we would enter a trading range by the end of the second hour. It's possible that it may have started with bar 14, and it's possible that we just entered a very tight range here for a couple of hours. Can you sell with a limit order 21 high? Because it's a triangle, I would not. So you either buy or you wait. And what about selling below 21 or below 16, a bear breakout below the triangle? It's right above the moving average. I'm not willing to take that sell. If we get a very big bear bar or a couple bear bars closing below the moving average, then I'll start to sell low. But right now, I only want to sell high. And by that, I mean, let's say we have a weak rally up here. Let's say we get a wedge rally over the next 4 or 5 bars and then a bear bar. I would consider shorting that. Bears selling the closed 22. They don't want 23 to go above 22 because they're afraid that a lot of bulls will buy it. We're getting near the end of the second hour. And so far, it's a disappointing follow-through bar after the first hour. First hour, big outside up. And it ended with bar 12. And we've not made much progress since the close of the first hour, bar 12. Right now, we're just a tick or so higher. Bear breakout below triangle, but right above the moving average and not a good sell signal bar 22. Tight trading range, so more likely buyers below the triangle 10 than sellers. What happens if 23 is a bear bar closing on its low and closing below 16, the triangle? It's still at the moving average, so most bears are not going to sell the 23 close. If 23 and 24 are both bear bars closing on their lows and closing below the moving average, you will start to get bear bars shorting. You'll start to get bears shorting. The hour opened with bar 14. So the hour opened with bar 13. Here's the open of the hour. And 24, the current bar determines whether the first hour or the current hour is a bare